The promise of more stimulus out of China had U.S. investors cheering early on today, but in reality, the U.S. may be the country least affected by what's going on over in China. Now, that may sound counterintuitive since the global economy is so interconnected and China is the world's second largest economy. But that theory has been backed by recent reports, and as Steve Leisman explains, a slowdown in China may not necessarily pose a big threat here in the U.S.
Much of the market volatility has been tied to concern over China's economic slowdown. But to several economists, it looks like the tail wagging the dog. The U.S. buys about 5 times more stuff from China than it buys from us. That means China is far more dependent on U.S. growth than the other way around. In fact, total trade, imports and exports, is only about 3% of the $17 trillion U.S. economy.
When China slows down, it tends to have ripple effects, of course, on the whole region in Asia and also emerging markets more broadly. But when you quantify the impact of a 1% decline in slowdown in China, it only has a 0.1% impact on U.S. GDP. So that means that the impact on the U.S. overall, both direct and indirect effects, is actually very limited.
A recent study of 27 countries found the U.S. among the least vulnerable to a sharp Chinese slowdown. Commodity sellers like Argentina and Russia would fare the worst. Still, some sound the alarm bells. They note that U.S. corporate profits, as opposed to the overall U.S. economy, will suffer because Chinese consumers buy less from American companies. They add that China is so ingrained into the world that a cooling of the Chinese economic dragon will spread a chill felt in the U.S.
For the U.S., clearly, domestic demand is much more important than external demand. The rest of the world does, however, have an impact, and unless you compensate for that, you do worse. The notion that the U.S. can drag the global economy along, it's no longer the case.
Yet, a recent study by economists at the Kansas City Federal Reserve Bank found a new upside for the U.S. from a Chinese slowdown. Tens of billions of dollars are now leaving the country and ending up in the U.S. economy. From condos to companies, the Chinese are buying U.S. assets, helping prop up real estate and equity prices. So far, the data back up the optimists. As China's economy has slowed, the U.S. economy has actually accelerated, suggesting that while the U.S. economy's fate is affected by China, it's not ultimately determined by it. For Nightly Business Report, I'm Steve Leisman.